y'all doing today? That's good, that's good. My name is Brandon, and I am the Student Loan Coordinator at Stanford. Within the next 30 minutes or so, I'm going to help you manage your student loans. So we're going to go over these 6 topics. And after these 6 topics, hopefully, you'll be a little bit more educated on your federal loans. So the first thing we're going to go over is terms. First term is the master promissory note. That master promissory note, you do have to fill it out. It is a legal document. You do have to fill it out in order to receive your student loans. Next is the direct subsidized loans. You do have to have a financial need in order to take out the direct subsidized loans. Also, no interest will accrue on those loans while you are enrolled in school. Next is the direct unsubsidized loan. The direct unsubsidized loan, you do not have to show a financial need to take these out, and interest will accrue while you are in school on your direct unsubsidized loan. The next is the PLUS loans. There's 2 types of PLUS loans. There is the graduate PLUS loan, and then there is the parent PLUS loan. So with the graduate PLUS loan, I apologize with both loans. The graduate and the parent PLUS loan. It does go into repayment once it is fully dispersed or when you do receive the loans. As far as the parent PLUS loan, it cannot be transferred into the child's name, so it is the parent's sole responsibility for the parent PLUS loan. Next is the grace period. The grace period is that 6-month period when you graduate or you withdraw or you enroll less than half time. Your grace period will start then. Also, you can make payments while you are in your grace period. So if you wanted to make payments, definitely make payments during that time. Next is the repayment period, simply the time that you have to make payments from beginning to end. That's pretty much the repayment period. Discretionary income, that's the difference between your income and the poverty guidelines, and you can go to the website ASPE to check the poverty guidelines. Next is loan consolidation. Loan consolidation is putting multiple loans together. So if you have multiple servicers and you do not want to deal with all of them, consolidate, put them together, one servicer. Consolidation, it is free. A lot of times you will be contacted by a third party and they will tell you, hey, we can consolidate for $200, $300, but again, it is free. You can go to the website studentloans.gov, consolidate your loans for free. Couple pros about consolidation, again, one payment, one servicer. Just want to deal with one servicer, consolidate. More than likely, you will have a lower payment when you do consolidate. And also, it is a way to avoid default. Consolidation is a way to avoid default. A couple negative things about it. When you do consolidate, you will stretch out your terms. You will pay more interest. Another thing is that if you are in the if you were looking into the public service loan forgiveness and you decide to consolidate, any payments that you made prior to, you will lose those payments. But we will discuss that public service loan forgiveness later. The Federal Family Education Loan Program. This program is no longer available as of July of 2010. But what it was basically where the private lenders gave students the loan and the government backed those student loans. Your loan servicer is pretty much that person that handles your loans, the person that you want to make the payments to, the person that puts the options on your account. You can go to NSLDS, you can find your servicer there, and when you do find your servicer, keep contact with your servicer. Just the person that you want to contact about anything in regards to your student loans is your student loan servicer. All right, so next we're going to talk about some different repayment options. So the first one is the standard repayment plan or a level. Same thing, standard or level repayment plan. That is that default plan that your servicer will put you on. It is the highest payment plan that you can be on. It is 10 years, 30 years. If you consolidate, again, consolidation stretches out your terms. Those are the eligible loans, and there's no requirement for that plan. The next is the graduated plan. The graduated plan is basically every 2 years your payments will increase until the loan is paid off. It is a 10-year plan. Again, those are the eligible loans, and you do have to request this plan from your student loan servicer. Next is the extended repayment plan. The extended repayment plan can be either fixed or graduated. Again, payments increase every 2 years. It is a 25-year repayment plan, and those are the eligible loans, and you do have to have $30,000 or more in order to enroll in that extended repayment plan. All right, so these are the income-driven repayment plans. There's the repay, there's the payee, there's the IBR, and there's the income contingent. So the first one is the revised pay-as-you-earn or repay. It is based off 10% of your discretionary income. The repayment terms are 20 years if you have undergraduate loans. If you have undergrad and grad loans, it is, or just graduate loans, it is 25 years. After those years, the loan may be forgiven and it may be taxed. The reason I say maybe is because you never know what the Department of Education is going to do with student loans. Those are the eligible loans. And you do have to recertify for your income-driven repayment plans. All of them, you have to recertify yearly. What that means is that you have to send in your proof of income, and you do have to send in your family size. And based on that information, they will give you a monthly payment. Also, for your repay plan, for the first 3 years, the government will satisfy the interest that accrues on your subsidized loans. After those 3 years, the government will satisfy half of the interest that accrues. As far as your unsubsidized loans, while you are on the plan, half of your interest will be satisfied. Next plan is the payee. It goes off of 10% of your discretionary income. 20 years after that may be forgiven, may be taxed. Those are the eligible loans. And again, you do have to recertify, and the government will satisfy for the first 3 years the interest on your subsidized. As far as the unsubsidized, you are responsible. Again, after those 3 years, you're responsible for the interest on the subsidized as well. Next, income-based. The income-based repayment plan. It goes off of 15% or 10% based on when you took out your loan. Also, depending on when you took out the loan, it can either be a 25-year or 20-year repayment plan. Again, it can be forgiven or taxed. Those are the eligible loans, and as you can see, it does include the FFELP loan, or the Federal Family Education Loan Program loan. And again, you do have to recertify, and the government will satisfy the interest for the first 3 years on the subsidized loan. Again, you're responsible for the unsubsidized interest. And then the last is the income contingent, where it goes off of 20% of your discretionary income. Again, it's a 25-year term. And then those are the eligible loans. And this is the only plan, this is the only income-driven repayment plan that allows for the Parent Plus loan. But that Parent Plus loan has to be consolidated in order for it to qualify for the income contingent repayment plan. It has to be consolidated. And you are solely responsible for all of the interest that accrues on the income contingent repayment plan. All right, so this is just an example. I'll just go over a couple of them. The first one, $10,000. If you have $10,000 loan, your monthly payment would be $111 for a total payment altogether for $13,322. Next will be the graduated plan. Your payments will be between $63 and $193. Again, every 2 years the payments will increase for a total payment of $14,212. And then again, it's not applicable for the extended because you do have to have $30,000. Go to the $50,000 plan. If you were on the standard plan, $555 for a month, total would be $66,612. The graduated, the payments will be between $317 and $952 for a total of the $7160. And if you were on the extended plan, and if it was a fixed payment, because again, extended can be either fixed or graduated. If you were on the extended plan, the monthly payment would be $322 for a total payment of $96,645. And then here is the income-driven repayment plans. So the income-driven repayment plans, they're based off a couple of factors. They're based off of your family size. They're based off of your income. They're based off of if you have any additional student loan debt. And they're also based off if you are supporting anyone more than 50% in your household. So those are the factors that are included with the income-driven repayment plans. So here's an example. This example is just for presentation purposes only. I mean, things were going to change. Things may change. More than likely will change in your lifetime, but this is just a constant. So let's go over a couple of them. For the repay plan, initial payment would be $143, final payment $606, time of repayment 23 years, total payment $90,000, no forgiveness amount. Next is the payee, again the same payment $143, final payment $507, 20 years, total payment $71,171, and then a forgiveness amount of $20,000, and more than likely that $20,000 may be taxed. All right. So the next thing is the forgivenesses and the discharges. So the first one is the teacher loan forgiveness. So with the teacher loan forgiveness, you do have to teach 5 complete and consecutive years at a low income school. And so in order to figure out if you work or if you're going to work at a low income school, you can go to the website TCLI, and they will have all the listed schools. All right, as far as the schools for the Bureau of Indian Education, those schools do qualify. They do count as low income schools. They will qualify. Another is the forgiveness amounts. So if you were looking for a forgiveness amount of $17,500, you do have to be a highly qualified teacher in science, math, or special education. As far as a forgiveness amount of $5,000, you just have to be a highly qualified teacher in education or secondary education. Those are the direct loans, and FEP loans are qualified, and your PLUS loans, they are not eligible. And if you were teaching at multiple schools, if you taught at 5 different schools for 5 years, that will be acceptable. You just need 5 different applications from those different schools.
So it says science, math, or special education. Science, does that only include natural sciences or also behavioral sciences?
Anything that's considered science. What will happen is there's an application. Take it to your school, your principal or your administrator fills it out. And if it says science, you put science. If it's chemistry, if it's anything related to science, physics, science, anything related to science, it qualifies.
How do you decide which repayment to do, or when do you decide that?
So what will happen is during your grace period, maybe like the 5th month, you actually receive a notification from your student loan servicer. And they will let you know that, hey, you're on the standard plan. This is how much. This is the payment. If you're not comfortable with that payment, with that plan, contact them. Let them know, hey, I can't afford this amount. And what they'll do is they'll work with you. They'll put you on, or you, I apologize, not put you on, but you can say, hey, I want to look into the income-driven repayment plan. They'll tell you those numbers. I want to look into a graduated plan. They'll tell you those numbers. So definitely, if you're not comfortable with it, contact your servicer. They'll let you know. All right. As far as the next one is the public service loan forgiveness. With the public service loan forgiveness, you do have to make 129 consecutive payments. Also, you do have to be employed with a qualified employer, and usually it is a public servicer, or they can be, I do believe it's a 501c3 tax exempt corporation. Also, the qualifying repayment plans for this public service loan forgiveness or your income-driven repayment plans, also a 10-year standard plan. After you make those 120 qualifying payments, the loan will be forgiven, and that amount is not considered tax. Direct loans, your grad plus loans qualify, and in order for your parent plus loans to qualify, the parent has to be the one eligible for the public service loan forgiveness. More about the public service loan forgiveness. So if you were a teacher and you did the 5 years, those 5 years that you use towards the teacher loan forgiveness cannot be used towards the public service loan forgiveness. So it'll be teacher loan forgiveness 5 years, public service the 120 payments. You cannot put those 5 years with those with the public service. The private loans are not eligible. And again, if you do consolidate, if you were making payments towards the public service and you decide to consolidate, any payments made prior to your consolidation will not count, because when you consolidate, it becomes a new loan. Starts over, starts from scratch. All right, here's some discharges. The first one is closed school. Okay.
To the last comment you just said, if you consolidate first and then do the repayment, will it still count towards
Yes, yes. So that's why I always tell people, if you were looking in the public service loan forgiveness and then you're thinking about consolidating, go ahead and look into consolidation. If you're comfortable with it, consolidate. Then look into one of the income-driven repayment plans, because those are the only plans that you can be on when you do consolidate. Right. Okay, so again, the discharges, closed school, basically is when your school closes and you're not able to complete your program, you may be eligible for a discharge of your student loans. Next is the total and permanent disability, where if you are not able to work, again, your loans may be discharged. Death, if you pass away, your family members, what they would do is they will send your death certificate to your loan servicer, and if it's acceptable, your loans will be discharged. And then there's borrower defense to repayment, where if a school lied to you or misled you in any way, stating that, hey, I can guarantee you a job after you graduate or anything, what you would do is you'll fill an application out, send it to the Department of Education. The Department of Education will look further into it. If they say, hey, we see the same thing you see, loan may be discharged. All right, couple suspension of your payments. The first one is deferment. Deferment is an entitlement given to you by the Department of Education, and no interest will accrue on your subsidized loans while you are on a deferment. A couple of the most common deferments that's available or that you may have heard of is economic hardship. You do have to be in a period of financial difficulty in order to qualify for a economic hardship. However, there is only 3 years for the life of the loan for the economic hardship deferment that's available to you. The next one is the in-school deferment. So you do have to be enrolled in school at least half time in order for your loans to be placed in an in-school deferment. Next is the unemployment deferment. Unemployment basically is if you are unemployed or working less than 30 hours, your loans can be placed in an unemployment deferment. With the unemployment deferment, again, you only have 3 years for the life of the loan, and they are used by 6-month increments. All right, the next is the graduate fellowship, where basically if you are in a graduate program, fill the application out, send it to your servicer, you can have that deferment placed on your account. Next is the post-enrollment. And so the post-enrollment deferment is only for Parent Plus and Graduate Plus loans. It's basically those 6 months after you, that's those 6 months you get when you graduate or you draw or drop down less than half time on your Plus or your Parent Plus or your Graduate Plus loans. Next is the military deferment. And so with the military deferment, you do have to be in active duty in order to have that deferment placed on your account. All right, the next one is forbearance. On a forbearance, the interest will accrue. So you are solely responsible for all of the interest that accrues on a forbearance. And so just a couple of the more common forbearances is a general forbearance. With the general forbearance, you only have 36 months for the life of your loan. but a lot of times the servicer will let you use it in different increments. Some may let you use it for 12, but a lot of them that I've noticed may only let you use it for like 3 months, 2-3 months at a time. And that is really to help you out, because on the forbearance, all of the interest will accrue and you will be responsible for it. It will be added to your balance. Once that forbearance has ended, that interest will be added to your balance. Next is the internship residency, where you do have to be in a medical or dental residency. You just fill the application out, send it to your servicer, have that forbearance placed. Next is the teacher loan forgiveness forbearance. And so with the teacher loan forgiveness forbearance, if the expected forgiveness amount will satisfy the anticipated outstanding balance at the end of the 5th year of qualifying service, you may qualify for that teacher loan forgiveness forbearance. So basically what that is saying is that if you have a balance of $10,000 and after 5 years, including interest, if it's under the forgiveness amount on a teacher loan forgiveness, if it's under $17,500, your loan will be placed on that teacher loan forgiveness forbearance. Now, if you have a $10,000 balance and you only apply for the $5,000 teacher loan forgiveness, then you would not get that teacher loan forgiveness forbearance. All right, next is the loan debt burden forbearance, where basically if your student loan monthly payment is greater than 20%, you do have a option to place that loan debt burden forbearance on your account. And the last one is the emergency disaster, where basically if there is a emergency or natural disaster in your area, you can have a forbearance placed. You can go to the website FEMA and you can see if there is a natural disaster or anything happening in your area. If so, contact your servicer and say, hey, there's a disaster, or there's a state of emergency in my area. I'd like to have a forbearance placed on my account. They'll look it up. They'll say, okay, yeah, I see it. 90 days on the account. But a lot of times your servicer may automatically place that option on the account. So, and when they do place it automatically, they will let you know. They will send you a notice. Or if you don't want it on your account, just tell them, hey, I don't want a forbearance on my account, and they'll remove it for you. It's not a problem. Next one is delinquency. So with delinquency, first day after your due date. So if your due date is on the 15th, the 16th, that's 1 day delinquency. After 90 days of delinquency at the end of the month, you will be reported negatively to the credit bureaus, and every 30 days after that until the account is brought current. You can bring the account current with a deferment or a forbearance. Default. So when your loan reaches 270 days of delinquency, it is labeled default. Your loan is labeled default, but you still have 90 days. You still have 90 days to actually do something in regards to, getting your loans out of default. Once the loan hits 360 days, that's when your loan will basically be transferred to the Department of Education. From the Department of Education, it will go to a collection agency. Once it hits that collection agency, they will try to work with you. If you're still not making payments with that agency, that's when your wages get garnished, that's when your taxes get took, and that's when your bank accounts, all the negative stuff that you hear, that's when that starts to happen. But you do have an option. You do have an option after deferment. After default, I apologize. You do have an option after default. So you can rehabilitate your loan. So basically what will happen is, if you are in collections, you have to make 9 consecutive payments. Once you make 9 consecutive payments, the collection agency will send you a letter saying, well, hey, you made these payments. Do you want to have your loans rehab? Say yes, say no. I would say yes. Once those loans are rehab, that default status will be removed, and you will be eligible to take out additional student loan debt. Now, the only thing is you can rehabilitate a defaulted loan only once. Now, that's not saying you can rehabilitate one time. That's only saying one loan, one rehabilitation. So just a couple tips. Get organized. Use the NSLDS. Use everything. Use everything that you have. Compare the different repayment plans. Call your servicer. Look into those plans because they were the ones to actually give you the numbers, the actual numbers. Budget. Get a budget for yourself. If you say that you can afford $200, subtract 50 from that because life happens, things happen, you know, so you don't want to spend all your money.
If you sign up for a specific repayment plan, but for some reason you have money over, like you signed up for a job and you got a bonus or something, can you just try and pay off more, or do you have to stick to the repayment plan?
Not at all, not at all. So if your monthly payment was $200 and you say, hey, man, I can afford $500, more than welcome to send in $500, $1,000, whatever you want to send in, as long as it's that $200. And also, when you do send in more, if you have multiple loans, you can decipher how much you want to go to the different loans. So if you want to just pay one loan off faster than the other, no problem doing it. But yeah, as long as you're satisfying that monthly bill, you're fine with sending in more. And again, budget. Make a budget for yourself. Know the eligibility for the forgivenesses and the discharges. Again, things change. So what I told you now may change next month or next year. So contact your servicer and ask them about the eligibility.
So I'm just curious with the current Department of Education looking at like changing this. Would we, like, if we chose one of these repayment plans, that would be our repayment plan even if there's the changes to like the one change that they want to do? Or would it be like, this change comes in, now we have to choose that plan?
So a lot of times what happens is when you do pick a repayment plan, you're grandfathered in. A lot of times, hey, you chose this plan, so as long as you stick to that plan at that time, you'll get the same, you know, rules and regulations of the plan at that time. But once you change it to a different one, that's when you go to the new rules and regulations of that plan. Next is make payments. Make payments during a deferment or forbearance. It just saves that interest, you know, because once that deferment or forbearance ends, that interest will be added to your balance, and it will make your balance higher. Make payments on time. If you were in the public service loan forgiveness, you definitely want to make those payments on time. Set up automatic payments. When you do set up automatic payments, you will receive a 0.25 interest rate reduction, and that will pay your loans off faster. Even though a lot of people say, hey, that's so small, it helps. Every little bit helps. Also, you can receive a tax deduction from the interest paid. You can receive a 1098E form. If you pay $600 or more, they will automatically send that form to you. Anything below that amount, just call them and request it, and they will send that information to you. Again, 600 or more, it will be sent to you. Anything below that, call them and they can get that to you. You are able to change your plan and your due date, but again, contact your servicer because different rules and regulations for different servicer. They'll let you know how to go about changing your plan. If you have any difficulties, questions, or concerns, contact your servicer. I mean, like I said, I can't stress that enough. Contact your servicer. They'll be the ones to help you. Any questions, contact your servicer. And if you have any questions in regards to your servicer, any problems, you can go to the ombudsman group. They are like a mediator between you and your servicer. And so here's all the links: studentloans.gov, you go to NSLDS, and then the lender website. All right, so that concludes my presentation. Any questions or comments at this time? Yeah.
For the Grad Plus loans, does the 6-month deferment automatically take place, or do you have to call your service provider?
You do have to contact your servicer. There's an application. You have to fill out, and you will see it on application, say post-enrollment, check post-enrollment, send it back to you. They'll place those 6 months on your account.
So, on one slide it said that if you consolidate your loans, you pay more, but what about the individual payments? Wouldn't I have to pay more in individual payments if I have 5 different loans than if I only have one payment? Like, would I have like 5 payments of like $100, or would I have one payment of, or would the 5 loans together, the payments, like the sum of it, would it be more or less than if I consolidated those 5 loans?
So if you do not consolidate, what will happen is your loans will be paid off within 10 years. Those are the plans, unless you go on an income-driven repayment plan. If you do not consolidate, loans will be paid off within 10 years. When you consolidate, your loan will be paid off within 25 years. So you stretch it out, more interest. That's why you'll pay more.
But the individual payments would be, so the payments month to month would be smaller if you consolidate.
Right. Right. But you can always, like you say, you can always pay more to pay it off. More than welcome to pay more.